Hello, everyone. Joe Mass here, and it's time for another market update. I'm going to try something different this time. I've got the camera up. I'm trying to put my shiny face on each slide. We'll see how that works out. Hopefully, it doesn't distract you or I too much, and we'll see how it goes. First thing I want to do is I just want to talk briefly about your investment policy statement. And your investment policy statement is really your blueprint to your success, right? And so this is the first thing that you should have discussed with your advisor so that we know how to manage your money properly. So in an IPS, there's 2 goals and 5 constraints. Your 2 goals are going to be a return objective and a risk objective. And so when it comes to return, you might be looking for appreciation, you might be looking for income. Okay, and there's a difference there. And when it comes to risk, you might be more concerned with a permanent loss of capital or a drawdown based on dollars, or you might be concerned with a drawdown on percentages. Okay, so those are the first 2 objectives that we're going to look at. We're going to look at both your risk and return. And remember that risk and return go together. And so a lot of people are so worried about drawdown risk and avoiding, drawdowns that they also miss out on those returns. So remember, risk and return go together. And then on the constraints, you have your time horizon, your taxes, your liquidity, your legal and unique circumstances. And so the longer the time period you have, the more aggressive you can be. The shorter time period you have before you need to spend your money, the less aggressive you can be. When it comes to taxes, we need to know if you're tax averse or tax aware. Okay. And then liquidity, when are you going to need money from the portfolio? That's an important factor for us to understand, as well as your legal and unique circumstances. And then some other areas that we like to look at are your other cash flow needs, your cash flow analysis, the effects of leverage. Some people want to use leverage in margin in their portfolios. And of course, the cycle analysis, which we'll talk about later today. And then for the real estate group, we always like to say real estate is the ideal investment because it stands for your income, D stands for depreciation benefits that you get for that tax shield, E stands for your equity buildup through the appreciation of the property, and then L is that you can enhance returns by using leverage. So again, it's your ideal investment. So again, we always want to be looking at your IPS. If there's ever a change in these factors, let us know so that we can rebalance your portfolios. Okay. Of course, this process, as we talked about last quarter, is a dynamic and adaptive process. Okay, so we're always evaluating you, right, and who you are and what you need, and then we're always evaluating the markets and bringing those together. And then we're going to, follow that process and repeat and rinse, rinse and repeat over and over and over. Step 1 is to, assess the strategies. 2 is again to review or build that IPS. 3 is to measure, and then of course 5 is to monitor. Okay, let's talk about cycles. So, we've been seeing this slide before. A cycle starts off when rates are low. That increases growth. That growth brings higher inflation. The higher inflation then is going to bring higher rates, which we hit the peak of a cycle. From there, slowing growth occurs. So lower inflation, rates come down, and we hit the trough. And so on the left-hand side of the screen, you see that that's the expansionary side, and on the right-hand side, that's your recessionary side of the cycle. Okay, so that's the easy to read slide. I am a clock builder. I apologize in advance. I know you just want me to tell you what time it is, and I'm going to try to do that. But we do have to spend some time on the clock building so that I can, properly explain some of these concepts to you. So here's that slide. Here's that clock building slide. On the top panel these are where we're going, right? This is like looking out of the windshield of the car. These are your leading economic indicators. And what we can see up here is that when they turn negative, sometimes a recession comes, and that's that red shaded area up there. Okay, and the distance or the time between when the indicator turns negative and that recession hits is illustrated by this white arrow here. And so you can see here the indicator turned negative and the recession followed very quickly. During this period, the indicator turned negative and the white arrow is larger. There was a longer period before we hit that recession. Okay, and then during COVID, again, there was a very short arrow, and here we are today. Now, the leading economic indicators are negative, but there's no recession yet. And so this white arrow is very large, and there may or may not be a recession coming, and we'll talk more about that. Okay, the blue panel is where we are now. That's like looking out of the side view mirror of your car, and these are the coincident indicators. And you'll notice here that they lag these leading indicators. Okay, and then the orange line, the orange bars here, these are where we've been. This is like looking out of your rear view mirror. These are your lagging indicators, and so you can see that the progression here is the leading indicators turn negative, but the coincident and the lagging were still positive into the recession. And it wasn't until after the recession in this example that the lagging actually turned negative. Excuse me. And so there in this period, we can see the same kind of relationship, negative, positive, positive. And the lagging didn't turn negative until the recession was already gone. So these are some things that we're looking at as far as the leading economic indicators, the lagging economic indicators, and the coincident indicators. And of course, what got us here, that's usually the road, right? The road the car is driving on, and that's what we call the Fed rate cycle. And so these red bars show the rates going up and down. As you can see, that makes that cycle, okay, the peaks and valleys there. So right now, every quarter, we look at about 55 factors for the market and for the economy and try to figure out where we are. And it looks like we're kind of right here. We're kind of flirting with, we really didn't have a severe downturn, right? The economy's still pretty strong, but we are off the high. So we're down from the high, but we haven't really started to make new lows. We're kind of flirting from going from right about here, this midpoint, over to a recovery. Now you got a down arrow here because there is a potential that we do end up retesting the lows and the economy weakening, and we do have a recession. But right now, it looks like we're just kind of flirting with this, and we're going to kind of skip this bottom half of the cycle here, and we're going to kind of go from D, or this midpoint, and come back over to this recovery. So nobody knows, but that's kind of what the data is showing. Let's look at a review of the market. So last quarter, the S&P 500 was up about 4%, just a little bit shy of that. April was a down month, as you see here, and then May and in June were positive months. When we look at sectors, you can see that the top performing sector for the quarter was technology, then utilities, then consumer cyclicals, and then S&P 500 was behind that. And so the S&P 500 has been hard to beat right now, right? It's you got more things below it than you do above it, and so that's just something that we pay attention to. When we look at the supply and demand, this top panel is looking at the Dow Jones, and this is the price. The black line is the price. The red line is the 200-day moving average. And so as long as that price is above the 200-day moving average, that would be considered to be a momentum trend. The trend is intact and it's still bullish. So the long-term trend is positive based on the 200-day moving average. Now, when we move to looking at the NYSE, the New York Stock Exchange, 1,500 stocks, and we're looking at the battle between buyers and sellers, right? The tug of war. We see that the black line represents the buyers and the red line represents the sellers. So typically, if the black line's up, the market's doing well. If the red line's up, the market's is having some trouble. So here, this red rectangle here that shows the quarter, and we can see that at the beginning of the quarter, the supply and demand were getting really, they're getting really tight. It was getting ready to switch, but we did have a good quarter, right? May and June pulled up, the buyer stayed in control. And then right now in the circle, we're at the end of the quarter and the sellers are starting to overtake the buyers. So we're just looking for a little, a transition point here right now. Okay, so short term, we're paying attention to this. And we'll talk more about what's driving the market in a few slides. Now, you've seen this chart before. This is showing the breadth of the S&P 500 last quarter. And so for the quarter, again, there's the return. The market was up about 3.92%. And out of the 510 companies, 7 were new, 8 were removed, okay? And there were 215 up for the quarter and 296 that were down. And so we can see that that breadth is really coming from those top stocks again here that are tech heavy. And again, as we saw from the prior slide in the sectors, that the tech was winning. So again, here you have your NVIDIA, your Apple, your Broadcom, right? You still have a lot of tech up in here that's been driving the market. And then down here, the Walgreens and Builders First, some of these companies here were bringing the market down. So again, what we look at here is that last quarter, there were more companies up than down. This quarter, there is more companies down, and that's putting more pressure on the few stocks that are really tech stocks that are driving the market to perform. So it is a little lopsided right now. Are we going to have a recession or not? Based on the Bloomberg consensus estimate, there's about a 31% chance of a recession. So we're going to explore that a little bit further. So here, what we're doing is we're looking at 8 factors. We're looking at kind of a recession dashboard. and 5 of those 8 are bullish. And so there's a 62.5% bullish reading and a 25% bearish and 12% neutral. And so again, if you think from the prior slide, with a recession, this is kind of supporting that. So again, there doesn't appear to be a recession in the cards, even though it can materialize at any time. Another thing that could cause a recession in the past is this negative yield curve. So the yield curve is just a graphical depiction of rates. And so here we see this is the U.S. Treasury active curve from 1 month to 30 years. Okay, so you can see that you're getting a lot more return in the short term compared to the long term, where normally we would like to see these lower rates or the short-term rates lower and these longer-term rates higher. We'd like to see a slope going up like this, but we don't. So that's called an inversion, and that is sometimes an indication of a recession. So that's still a piece of evidence that's out there that is negative, along with those leading economic indicators. They're another strong piece of evidence that a recession is still coming. So when we look at all the critical facts here, what we're going to do is we're going to look at that windshield of the car again, and that's the ISM indexes, right? The manufacturing and services. If they're above 50, that's expansionary. If they're below 50, that's contractionary. So this red line right here is 50-50, and you can see that they both were, they flirted with both being below 50 here, and then services has turned back up, and manufacturing is just barely negative. Okay. And when we look through the rear view mirror of where we've been, we look at GDP on this middle section, and we can see here that we still have what, 1, 2, 3, 4, 5, 6, 7, maybe 7 or 8 quarters of positive GDP. So again, we haven't been in a recession yet, as this data is showing. On the bottom panel, we're looking at the S&P 500 on the white line, and the orange line is the Fed rates, right? And so we can see that they paused. The market has sheared that. It's continued upward. And so again, we'll talk about rates further, but the Fed is kind of being very patient and waiting to see if they really should cut rates or not. Okay, so that's why we're looking at the ISM indexes, the GDP, and the Fed funds rate. Okay, so what's driving the market? We'll talk about the interest rates and the factors in a moment. Here we look at 55 factors each, pretty much each week to determine if we're bearish or bullish. And right now we're about 60-40, and this has been staying pretty close to that 50-50, 55-45 over the last several weeks and months. But right now we're 60% bullish and 40% bearish. So again, on the bull side, we're up here. We're not 100% bullish. On the bearish side, there is a chance for retracement. So there is some short-term indicators and data that we're looking at that we could be starting to pull back. Will it start a new bear market? We don't know yet, of course. I wish we did. If we could predict the future, that'd be a really cool thing to do, but we can't. But again, right now, we're still a little more optimistic than we are pessimistic. Okay, so again, you've seen these factors before. What drives the market is going to be inflation, interest rates, corporate earnings, the Federal Reserve's posturing, and geopolitical events. Obviously, if these factors are, if inflation's up, interest rates are up, corporate earnings are down, the Fed is restrictive, and geopolitical events are volatile, that kind of is conductive to that negative or bear market. And the flip side is true, right? If inflation's down or low, or interest rates are down or low, earnings are up, the Fed is accommodative, and geopolitical events are calm, that usually is good for the market. On top of this, we're always looking at 3 types of data. We're looking at fundamental data, technical data, and economic data to help us make these decisions. So we're not just looking at any one data point. We're trying to look at the preponderance of the evidence to really make better decisions as we manage your money and readjust portfolios. Okay, so I know this is a clock building slide again, but this is inflation. And so let's just try to keep it simple. This orange line up here is the rear view mirror. This is the PCE inflation. This is where it's been, and it's currently at 2.6%. The red line, that's the road. That's the road the Fed wants us on, and that's a 2% kind of target date or target rate, that they want. And the white line is looking through the rear view mirror, there is looking at the rear view. It shouldn't be. This is a mistyped rear view windshield, but this white line is looking forward. This is looking out of the windshield of the car, not their rear view windshield. who edited my slides. And but this is a survey done by the University of Michigan, and this is where they think rates are inflation is going to be over the next 5 or 10 years. And you can see it is behind here, it's about 3%. So the orange line is the PCE where we've been. The white line is where we're going. The red is the road that the Fed wants us on. Now, if we look at another Michigan survey here in this purple line, this is the looking through the windshield for the next year. And again, that's coming down about 3%. And then, of course, the CPI, which is a little more familiar to most people, which is also a rear view mirror looking backwards, is at 3.3. So in general, inflation's been coming down. And so inflation comes down, stocks go up, and vice versa, as we've seen. So this is what's driving the market. And as I mentioned a few minutes ago, the Fed is going to be patient right now. Okay, they are not in a hurry to bring rates down because they don't want inflation to pop its head back up, and then they're going to have to, change course. So they're being patient in their decisions, and we'll look at a little bit more of that in the next couple of slides. All right. So in the 10-year Treasury, again, in general, when rates are down, stocks are up. And when rates are up, stocks are down. So that's the general relationship. And this, again, the red box here is the last quarter. And we can see that the first part of April, remember, was down. And those rates were going up. The market had, struggled a little bit. The back half of April and into May, it started to come down. And that did drive the market. And then you can see that it's coming back up again. So in June, again, we did have a pretty good month. So this isn't tracking perfectly. But its interest rates have started to come up a little bit. They've peaked, they've come down. And again, that's why we saw that supply and demand coming together. That's why we're seeing some indications that we could be having an inflection point. Again, that's why we're 40% bearish. So there is, it is, we're not out of the woods yet. We're just not into a brand new bull market. There is data that suggests that we need to be cautious. Okay, so that's what the 10-year Treasury is doing. Now, of course, earnings are one of the most important things, and earnings are probably more important than the interest rates. And so those have been strong. And again, generally, if earnings are down, stocks are down, and if earnings are up, stocks are up. And so here we can see that over the last 12 months in the S&P 500, we have earnings of about 228. They're expected to be about 241, and so that gives us a 6 to 7% growth rate. Now, if we're looking at the estimates for the year past on this orange line, you can see that we have $253 consensus estimate. Then we have 284 and 300. So again, as we've shown you in the past, these aren't straight lines, but in general, earnings are still being pretty resilient, and if they continue upward, they're going to continue to be supportive of a bull market. So what does all that mean? Again, it means that as of the date of this slide, the market was at 5,500. The best target price is 5,969, and so that equals a change of about 8%, 8.35% over the next 12 months. So there's still some room in the market. Again, doesn't mean that it goes straight up, but fundamentally speaking, there is still a little bit of room to go. Let's look at the Fed funds rate. We looked at the 10-year interest rates. Now we're looking at the Fed funds rates, and again, generally speaking, rates down, stocks up. And so we can see these yellow dots are where the Fed fund governors have voted. And so we can see that this green line is the median expectation of rates. And we can see that in general, although there's disagreement on when and how much, that generally the Fed believes that the rates are going to be coming down, and that's positive. Now, the next couple slides are interesting. What this is showing that based as of July 3rd, 2024, that there's approximately 2 rate cuts still to come this year. And so what we're looking at here is it's kind of hard to read because this is a probabilistic model. But by 12/18, you can see that there's a high probability that we have 1.8 or 2 cuts in there. So again, in general, we see rates coming down from 5.3 to 4.78. Now, what's interesting, right, is that at the beginning of the year, if we go back in time to 1/1, so January 1st of 2024, remember the market was expecting the Fed to drop rates about 6 times. And so again, here we can see that by 12/18, they were expecting about 5.6, so rounded off to 6 cuts. Okay, so the market has been very resilient as the Fed and the market. So the dot plots are what the Fed says they're going to do. These charts are the probabilistic charts from the futures market. So this is what the market says that they think rates are going to do. And so by looking both at what the Fed says and what the market says, it can either converge or diverge. And so we find good information in that. Okay. I just think that's interesting that the market's done so well. You would have thought that at the beginning of the year, if they were expecting 6 rate cuts and we ended up with none so far, that we really would have struggled a little bit more than we have. Okay. Oh boy, this is a tough slide. This is definitely a clock building slide, but this is geopolitical risk. And so the geopolitical risks remain high, but interestingly, the volatility has been really low. So volatility is measured by the VIX index, the fear index, is low. So what we're looking at here is that the VIX over the last 20 years has averaged about 19, let's call it 20, okay? And currently we're at 12. So we are well below the second we're at that second or first deviation point below. Okay, so we're at 12, and historically we've been about 20. So if the volatility stays low, that's going to be good for the market. If volatility spikes up, that's going to be bad for the market. So let's see if we can use our windshield and rear view mirror concept to determine what this volatility is doing. So where we've been, this yellow line shows us where we've been, and this is the rate of change over the last 18 days. And so you can see that rate of change on volatility is down 4. So in this case, that's good. Okay, this isn't stock, this is the volatility. We would like to have a lower volatility. And so we can see here on that yellow line that volatility has been down over the last 18 days. Now, is it going to go up? Is it going to go down? Is it going to go sideways? What can we look at to help us determine that? So here we're gonna see where we're going. We're gonna look out at the windshield of the car, and here what we're looking at is a statistical measure called the Hurst ratio over the last 18 days. And the way you read this Hurst ratio is that if it's above 0.5, it means that the market's going to continue in that direction. So if it was down, it's going to continue down. If it was up, it's going to continue up. Okay. If the Hurst ratio is below 0.5, it means that the market's going to change directions. So if it was down, it's going to go up. If it was up, it's going to go down. So anything above 5 means we're going to continue in that direction, and anything below 5 indicates that we might go change directions. Now, these courses aren't guarantees, but what we have here is we have the current Hurst ratio at 0.72, meaning that the market is going to continue in the same direction, or the VIX is going to continue in the same direction. And in this case, over the last 18 days, the VIX has been going down. So if this indicator is correct, it looks like volatility will continue to stay down. Now, if this indicator was at 0.3, we would be thinking that volatility would really be getting ready to spike back up, and that would make us more bearish. So right now, we're not concerned because volatility has been down, and it looks like it's going to stay down for a while. And so that bodes well for risk-on investments, okay? So I apologize for all the lines and charts and graphs here, but hopefully you get that there are geopolitical risks out there, but the market's not picking that up or worried about that right now based on the VIX, the fear index, the volatility index, and it looks like it's going to continue to stay low. That's what you need to take away from that. But I appreciate your patience as I go through this very pretty but very ugly chart, okay? All right, what's the outlook? Well, again, we're still 12-month view. We're still pretty cautiously optimistic. The markets have been doing well. We think there's that bull out there, but again, there is evidence, 40% evidence, that we could have some pullback. So again, we still think being measured is the right response. We're not ready to go into all equity, and we're not calling you to go into all cash, right? We're still managing very prudently. Again, remember our goal, our mandate is we're trying to build portfolios that have reasonable returns with reasonable risk over reasonable time periods for reasonable people, okay? And we think that that's what we're doing right now. Okay, so looking at the S&P 500, what's to come? Risk-on assets are still in favor, but a pullback toward long-term average remains in the cards. And what I mean by that is the market's up double digits for the year. Usually the market's up single digits, let's say 7% for an example. So if the market is mean reverting and it's up at 15 or 10 or 15% and the average return is 7, then there's still some chance that it comes back down to its average return, okay? But we're going to use the same concept of the windshield and the rear view mirror, and we're going to use that rate of change and that Hurst ratio again. So here's the S&P 500. Over the last 18 days, it's up 2.89%. That's where we've been. Where might it be going? Well, again, looking at the Hurst ratio, it's above 0.5, meaning that it's probably going to continue in the same direction. And so since that direction has been positive for the last 18 days, there's evidence that we continue in that direction. again, if this indicator, this first ratio is down at 0.25 or 0.3 or 0.4, we'd be thinking that that change might be closer than it is. Okay, so that's how we read that. Now, you don't want to fight the Fed, right? They're in charge, so you don't want to fight the Fed. And the market is expecting, like we showed you, 2 rate cuts. Now, what's interesting is that at the beginning of the year, we expected 6 rate cuts, and we haven't got any. So the market has been very resilient with this bad news. What's the bad news is that we thought we were going to get 6, and we haven't got any. So the market's been very patient with the Fed. Okay, so they're still expecting 2. If we don't get any, there could be a point in time where the market decides to have a hiccup and it goes down. But right now it's been very resilient and patient. So when we're looking at that recession again, the yield curve's inverted, so that's not good. That's not a good piece of evidence. It is shifting, however. The leading economic indicators are still negative again, so that's something we're worried about. So a recession still may emerge, but we just don't have enough data yet to go one way or the other. Again, we're about 60-40 on that. So there is increased opportunity for active and tactical management in both our asset allocation and our stock selection. And we saw that being that the S&P 500 had more things below it than above it. So we do have some room to find some value. Again, since most of the stocks are concentrated, right? Most of the stocks were down for the quarter, except for what do they call them, the Fab 7 or whatever now, or the FANGs. And so, we can look for companies that are world-class operators, have world-class management, have good allocators of capital, strong earnings, low debt. So we can evaluate the fundamentals and pick those companies and avoid the majority that don't have good fundamentals. Okay, so we're still very much in an active stock picking mode. Now, it's also important to remember you have to be patient. Buy and hold has been in favor this year. You would have been better to do the buy and hold, stay in equities instead of trying to get in and out and in and out and in and out. Remember, timing is very difficult. So this year, you would have been better off remaining in equities instead of trying to guess when the market might turn. Corporate earnings, again, which is one of the major drivers of the market, they've been resilient. They're still pretty positive, and so that's good for the market. And again, the geopolitical events are still a factor. There's a lot of them, too many to discuss right now, but they're hard to model and they're hard to measure until once they've happened. And so again, the best way to handle this uncertainty here is to have your parachute before you need it, and that's having a good financial plan integrated with your investment policy statement. Okay, so what do I do? What do you do? Well, hold enough cash to make you comfortable, right? Update your financial plan. Okay, look at your CPR plan, look at your financial plan. Review your investment policy statement like we started off with to see if there's been a change in your risk objective or your return objective or one of your 5 constraints, okay? So make sure that you update and you have a clear idea what your blueprints should look like. Again, you'd never want to go out and build a house without blueprints, and so you really don't want to build a portfolio without having an integrated financial plan with your investment blueprints, your investment policy statement. So once you've reviewed that, communicate any changes in your willingness or ability to take risks. So if there's a material change in your IPS factors, please let us know so that we can retune, readjust, recalibrate the portfolio based on your new set of circumstances. Okay. Now, what are we going to do? Well, we're going to listen to you, right? That's the most important thing that we can do. And then we're going to adjust your IPS and financial plan as necessary. So again, communication, there's a sender and receiver. We have to be on the same page. So make sure that you're communicating any concerns, worries, negative or positive changes in your IPS factors so that we can discuss whether we need to make adjustments to the portfolio. We're going to continue to manage cautiously. We're going to continue to look at the preponderance of the evidence and all the data. We're going to monitor and adjust. We're going to, basically do 3 things. We're going to investigate, we're going to analyze, and we're going to communicate. And so we'll continue to do, follow what we should be doing. So as an analyst, these are the 3 things that we do over and over and over and over. We investigate, we analyze, and we communicate. So that's what we'll continue to do. And so together, we're going to stay on track. We'll get you through this year. We'll get through the election and all these geopolitical events. And we look forward to talking with you over the next several weeks here if you need to make changes to your portfolio. And again, we will be updating you in writing and with other weekly videos. So look for those. And again, next quarter, I'll see you back here. Hopefully this video thing will work out okay. And we'll try the video next quarter.
The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.